This is Nightly Business Report with Tyler Matheson and Sue Herrera.
The committee judged it appropriate to wait for more evidence.
And wait, it did. The Federal Reserve says now is not the right time to raise interest rates. But with the economy strengthening, what held them back?
Confused response. Stocks rose, then fell, then rose, and fell again as the market tried to figure out what the Fed decision means for the economy and your money.
And tuning in, a little-known company makes a big acquisition to become a real player in the fast-changing U.S. cable business. All that and more tonight on Nightly Business Report for Thursday, September 17th. Good evening, everyone, and welcome. I'm Sue Herrera.
And I'm Tyler Matheson here in Washington outside the Federal Reserve's headquarters, where today the Fed decided to keep interest rates right where they are, near 0%. The decision was anyone's guess right up to its release at 2 p.m. Eastern Time. But in the end, Central Bank Chair Janet Yellen said this was not the right time to raise rates, which were last hiked in 2006, even as key parts of the economy not only recover, but also strengthen. So the guessing game continues, with attention now turning to the Fed's meeting in October or December, or maybe even into next year. Hampton Pearson has more on the decision and what ultimately held the Federal Reserve back.
One of the most highly anticipated Federal Reserve meetings in years ended with monetary policymakers deciding to keep interest rates at record lows due to concerns about a weak global economy, low inflation, and financial market jitters.
In light of the developments that we have seen and the impacts on financial markets, we want to take a little bit more time to evaluate the likely impacts on the United States.
The U.S. economy, especially the jobs market, is solid, with the unemployment rate expected to drop below 5% next year. But the global slowdown, the Fed now says, might impact domestic economic growth and inflation. China's economy has slowed, the price of oil has dropped again, and emerging markets are taking on more debt because of the strong dollar.
We fully expect those further effects, like the earlier moves in the dollar and in oil prices, to be transitory. But there is a little bit of downward pressure on inflation.
Meanwhile, market analysts are worried adding those global concerns to the Fed's checklist for raising rates may add to market volatility.
This opens Pandora's box to a whole host of other questions. Is there something else that we don't know about?
It's the financial market conditions and the financial market conditions tightening, and that's what they basically highlighted here as to why they held off.
So now it's on to the next Fed meeting at the end of October, with the Fed's data-dependent net now expanded to include global developments. For Nightly Business Report, I'm Hampton Pearson in Washington.
And there was drama on the street as the market tried to interpret that decision by the Federal Reserve. Stocks fell sharply after the release, then rose just as fast, only to rise even further and then drop. By the close, the Dow Jones Industrial Average fell 65 points to 16,674. The Nasdaq was 4 points higher. The S&P 500 lost 5 points. Yields also fell following the decision, as you can see from the chart of the 10-year Treasury note. Bob Pisani was at the New York Stock Exchange for all of today's ups and downs.
Well, that was something. Even though the Fed did not raise rates, they did surprise. And for everybody who said, oh, the Fed isn't going to raise rates and everybody knows it, apparently everyone did not know it. Now, the Dow was up modestly going into the Fed announcement. Then it dropped a bit initially, and then it rallied more than 250 points in the following hour. Then, I'm not done, it went all the way back down almost 300 points in the last hour before settling just off the lows for the day. Interest rate sensitive regional bank stocks fared especially poorly, so Fifth Third, Citizens, Zions Bancorp, KeyCorp, all of them were down 3 to 4%. The dollar weakened. Now, that would normally help some commodity stocks like Freeport-McMoRan and maybe some big industrials like General Electric, but not this time. So what exactly did happen? Well, there's a lot of conflicting trading opinions playing out. A likely explanation is that some bought heavily on the initial announcement that the Fed would not raise rates, but traders sitting on large profits in the last few days sold heavily into it. That makes some sense. And remember, there's also a whole school who have argued that the Fed not raising rates would send a signal that the U.S. and global economies are still weak, hardly the sign of confidence some are looking for. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
Randy Kroszner joins us now for more analysis on the Fed and the economy. He's a former Fed governor and now a professor of economics at the University of Chicago's Booth School of Business. Professor Kroszner, welcome. Good to have you with us. What is the Fed waiting for, and is there a danger that in waiting for things to get just perfect, they wait too long?
So there's always going to be some reason not to act. There's always going to be some piece of data that's not perfect or some volatility somewhere. But I think they were concerned that they're not seeing enough signs yet that they're going to be on a path to reach their 2% inflation goal. Inflation has been moving down both in the recent report and in the personal consumption expenditure index, which is the main index that they focus on. And so I think they're concerned that inflation isn't quite coming back as they had expected, so they're going to be cautious.
Randy, what did we learn from the Fed today in terms of what they're really watching? It seems to me that they're watching China, oil, the drop in commodities, and the global market turmoil that we've seen recently, perhaps much more closely than a lot of market participants thought they were.
I think the market participants should have realized that these things may have an impact on the U.S., both in real economic growth as well as it may have an impact on inflation, because if the dollar strengthens, and other economies are weakened, and especially if their currencies are going down, that could put downward pressure on U.S. prices. And so there is, the U.S. is integrated into the world economy. The Fed always looks at these issues. They've become more salient recently, particularly China.
You know, Randy, I think a lot of people would have thought that if had the Fed raised interest rates today, it would have been, quote, a vote of confidence for the economy, a sign that things, in the Fed's view, were where it wanted them to be. Should we view today's non-action as a vote of less confidence in the health of the U.S. economy?
Well, certainly if they were sufficiently confident in the labor markets and sufficiently confident in the path for inflation, they would have acted. But the tumult around the world has made them a little bit less certain about that. And I don't think it should be taken as a vote of no confidence. But obviously, if they had been more confident, they probably would have acted.
So is an October rate hike, in your book, on the table, or do they wait for December or maybe into 2016?
So I think October is highly unlikely because they said they wanted to understand the impacts of what's happening in China. That's probably going to take a little more time to see. They also want to make sure that inflation is getting back to its 2% goal. There's not going to be a lot of data between now and October for them to really change their assessment. Possibly by December, so I think December is on the table, but it also could be beyond that.
Even though it's an election year coming up?
The Fed is going to do what it thinks is the right thing to do, and they will move when they feel that they need to move. Whether it's sort of December or March, I don't think is really, or September, December, or March is really going to matter. And in terms of the electoral cycle, and the electoral cycles, I don't think going to have that much of an impact on their decision choice.
Professor, thank you very much. Professor Randy Kroszner with the University of Chicago's Booth School of Business. Sue?
So, Ty, what does today's Fed decision mean for stocks and your investments? Russ Kosterich is the Global Chief Investment Strategist at BlackRock, the world's largest asset manager. Russ, welcome back. Nice to have you here.
Well, thanks for having me.
So what are the implications longer term for stocks? We saw the wild swings that we saw today. What's your prediction?
Well, I don't think this is going to matter as much as we're all talking about. The interesting thing is you had these incredibly large intraday swings, but if you think about where the market was ahead of that decision, it was close to unchanged. If you look at the Fed futures contracts, they suggested investors believed the Fed was not likely to go. The Fed didn't go, and at the end of the day, the market was close to unchanged. So we spent a lot of time hemming and hawing about this, but the reality is whether the Federal Reserve raises interest rates a quarter point in September, October, December is not going to be the primary determinant on how U.S. stocks do for the remainder of the year.
How do you feel about U.S. economic growth and what it implies for stock valuations? Is the economy healthy enough, growing fast enough to, one, justify stock prices where they are and maybe even leave a little room for growth?
Stock prices are probably close to fair value. I think in the U.S. they're a bit high. They're cheaper outside of the United States. The problem right now in the U.S. is you have a very mixed picture. If you look at the labor market, very healthy right now, with the exception of wages. We're creating jobs at the fastest pace since the late 1990s. And relative to where the Fed funds rate was back then, you could argue the Fed should have gone today. I think what's keeping the Fed on hold is other parts of the economy are looking a bit more wobbly. We've seen a softening of manufacturing, a softening of industrial production. And of course, once you look outside of the United States, and you talk about the global economy rather than the domestic economy, that does look less inspiring.
So it sounds like that's a pretty good recipe for a continuation of higher equity values.
Well, certainly if we remain in this environment where inflation is low but not too low, rates are low and stable, these are factors that have supported equity valuations and are likely to continue to do so. That said, and I think you were getting at this a moment ago, if equities are going to move higher through the remainder of the year and into 2016, it's unlikely to come from multiple expansion, from higher valuations. It needs to come from earnings growth, and that's more likely if we see a pickup not only in the U.S. economy, but also the global economy.
You know, Russ, what were you thinking today before this meeting? Did you think they were going to raise rates? And are you disappointed? Do you think they missed something, or do you think they're playing it basically the way they should be playing it?
Well, the baseline was that they were not going to raise rates. You saw that in the futures market. I think to some extent they were unlikely to go, given how fast inflation expectations have fallen. But I do think there's an argument that they missed an opportunity. And the reason I say that, again, is let's frame the question slightly differently. Let's not talk about raising rates for a moment. Let's talk about normalizing rates. As I mentioned a moment ago, we've got the best labor market right now in the U.S. since the late 1990s. Back then, the Fed funds rate was at about 5 or 6%. So the question is, in an environment in which the U.S. economy is doing okay, the labor market is doing well, is the right policy rate 0? And I would say probably not, and that's why I think they may have missed an opportunity.
All right, Russ, thank you so much for your perspective. We appreciate it. Russ Kosterich with BlackRock. Ty?
Well, of course, Sue, one part of the economy that is very sensitive to interest rate moves is housing, mortgages. But how much would a rate hike really have mattered to the housing market today? Higher rates certainly do cut into affordability, but surprisingly, home buyers are less worried about that than about other roadblocks to home ownership. Diana Olick explains.
Even before today's Fed decision, consumers were not as worried about rising mortgage rates as you might think.
85% of those surveyed said that they would carry on with their home purchase plans, even if rates topped 5%. That's significant. It tells you what the state of the home buyer mind is.
Here's some information on the house.
In fact, home buyers today are more concerned about qualifying for a mortgage and finding the right home than they are about rising rates, according to another survey by Trulia. And it's important to remember that mortgage rates do not directly follow the federal funds rate. They're dictated by bonds that generally track the yield on the 10-year Treasury. That said, when the Fed raises its lending rate, the cost of money for banks goes up, and banks could in turn recoup that higher cost from borrowers in the form of higher rates. That could hit some harder than others.
Our core market is first-time home buyers, first move-up home buyers, and they're price sensitive.
More important to builders and buyers is access to credit, which is easing slightly, according to a new lender sentiment report from Fannie Mae. But make no mistake, credit is still tight, and even a small rate hike could knock an estimated 7% of mortgage applicants out of the running. Not because they wouldn't be able to afford the monthly payment, but because they wouldn't meet the required debt-to-income ratio.
It doesn't matter how low the interest rate is. If you can't get a mortgage, you can't get a mortgage.
What really matters most to housing is a strong economy, and rising rates would be a sign of that. For Nightly Business Report, I'm Diana Olick in Washington.
And today, we learned that builders broke ground on fewer homes last month. The Commerce Department reports that housing starts fell 3% in August, and construction activity slowed sharply in the Northeast and the Midwest. The decline, according to some, could be a sign that the housing recovery will continue, but it will be bumpy. Ty?
And Sue, some positive news on the labor market. The number of Americans filing new applications for unemployment benefits fell last week, lowest level in 8 weeks. Initial claims for jobless benefits dropped 11,000 to a seasonally adjusted 264,000. Claims have remained below 300,000 for 28 straight weeks. And coming up, the deal General Motors made with the Department of Justice over its handling of those deadly ignition switch defects.
Don't expect $100 oil anytime soon. According to Reuters, OPEC says even if the oil market stabilizes, prices are unlikely to return to that level until the year 2030 or 2040. The cartel reportedly says prices will grow by no more than $5 per barrel a year to reach $80 by 2020. Today, West Texas Intermediate fell 25 cents to $46.90 a barrel.
Well, it was a costly day for General Motors. As we first reported last night, the automaker has agreed to settle with the Department of Justice over the company's handling of defective ignition switches. It also agreed to potentially settle civil lawsuits. The total cost to the company will be more than $1.4 billion. In trading today, shares of GM rose slightly. Phil LeBeau now with more on the settlements and what they could mean for GM as it tries to move forward.
With two costly agreements, General Motors takes one big step towards wrapping up cases tied to defective ignition switches that led to the deaths of 124 people. First, GM and the Department of Justice reached a deferred prosecution agreement for failing to disclose a safety defect and committing wire fraud. That means GM won't face those charges in exchange for meeting several conditions, including paying a fine of $900 million.
They didn't tell the truth in the best way that they should have to their regulator and to the public about a serious safety issue that risked life and limb for Americans.
One of those victims was 16-year-old Amber Rose. Her mother called today horrifically painful, partially because no past or present GM employees are facing individual criminal charges. But CEO Mary Barra says her company is not putting the ignition switch scandal behind them.
We didn't do our job. And as part of our apology to the victims, we promise to take responsibility for our actions.
GM has also agreed to potentially settle more than 1,800 civil lawsuits involving owners of defective cars. That will cost the company more than $500 million.
These settlements mean many, but not all of the legal cases surrounding defective ignition switches have now been resolved. And General Motors has moved a step closer to getting out from under a cloud of scandal that has rocked the company for the last year and a half. Phil LeBeau, Nightly Business Report, Chicago.
American Airlines has resumed flights after computer problems briefly grounded some flights. The flights affected were at 3 airports: Chicago's O'Hare, Dallas-Fort Worth, and Miami. About 300 flights were delayed, and the ground stop lasted 2 hours. American has apologized for the inconvenience and said it has no reason to believe that the issue was hacking related.
Well, Sue, Verizon warns about its future earnings, and that is where we begin tonight's Market Focus. The company says earnings may plateau next year because of changing consumer habits. Still, the CEO believes the company will outperform despite competition.
So is there impact? Is there innovation? Yeah, I think that's the mark of a healthy industry. But we've been able to hold our own and grow and deliver profitability.
Shares fell 2% to $45.23. On to Rite Aid now, a down day for that drugstore chain. It missed on the bottom line, though sales did beat forecast. The company also trimmed its earnings guidance for the full year. Shares slid almost 11% to $7.66.
The generic drug maker Perrigo urged shareholders to reject Mylan's unsolicited takeover offer for the firm. Perrigo saying the nearly $30 billion offer undervalues its company. Perrigo fell a fraction to $181.08. Mylan rose slightly to $49.37. Adobe reporting better than expected results. The software firm's profit and revenue topped analyst estimates, helped by subscriptions to its Creative Cloud software suite. But forecasts for this quarter's results were below consensus. Shares spiked initially after the close before tumbling during the regular session. The stock was off a fraction to $80.31. Ty?
Sue, a $17 billion deal in the cable industry. Cablevision being bought by the European communications company Altice, creating the fourth largest U.S. cable operator. That sent shares of Cablevision up more than 13% to multi-year highs. The acquisition is part of a long string of takeovers in the industry, underscoring the massive changes that are taking place. Julia Boorstin has more on the reasons behind the deal and what may happen next.
Altice is pushing into the U.S. cable market, which is in the midst of major consolidation. Altice looking for greater exposure to the New York tri-state area, where Altice says customers are willing to pay for premium services. This after making its first move into the U.S. market with a $9 billion deal to acquire St. Louis-based Suddenlink Communications. And Cablevision, facing growing competition, was looking for an exit.
They're the only cable operator in the United States that really has a head-to-head fiber competitor in most of its footprint with Verizon Fios. That just makes it much, much tougher. And they know the business better than anybody, and they're sellers.
This deal, which makes Altice the fourth largest cable operator in the U.S., is just the latest in a string of deals. Charter agreeing to buy Time Warner Cable after Comcast's proposed acquisition of TWC fell through, and AT&T recently completed its takeover of DirecTV. The industry is consolidating as cord cutting becomes a real threat. Declining pay TV numbers are pushing cable giants to focus more on offering high-speed broadband to lure customers with bundles of services, including broadband, TV, and phone. Now the question is what deals could be done next if Comcast is looking to do another deal, or if companies with international exposure such as Liberty Global or Discovery Communications come into play. But analyst Craig Moffett points out with so much consolidation already, there aren't that many targets left.
I don't think Cox is for sale. And after that, you're talking about small companies, Mediacom, and then it gets smaller and smaller. Cable One, they're 500,000 subscribers. So if you want to get big, it's going to be a lot of small acquisitions.
Altice's acquisition of Cablevision is sure to draw regulator scrutiny, but if regulators do sign off, the deal is expected to close in the first half of next year. For Nightly Business Report, I'm Julia Boorstin in Los Angeles.
Coming up, the Fed may not have raised rates today, but it will at some point, and you'll want to get your mutual fund portfolio ready. An update now on a story we told you about Tuesday. General Electric announced today that it will create as many as 1,000 jobs in Europe to build an engine development center there. This on top of the 500 jobs it said it would move overseas earlier in the week, as the company cited Congress's failure to reauthorize the Export-Import Bank, which guarantees loans for U.S. companies that do business overseas.
All right, Sue, so what will rising rates mean for your mutual fund? The Fed didn't move today, but it will at some point. Here to assess how it will impact fund investors is Brian Reed, chief economist at the Investment Company Institute, the mutual fund industry's main trade group. Brian, good to have you back. Thanks. The Fed didn't raise rates today, but it did say that by 2018, it expects short-term interest rates, the federal funds rate that it controls, to go from 0 to 3%. What does that mean if I'm a bond fund investor? How much damage am I going to suffer to the share value of my fund?
So the focus today has been on the short-term interest rate. What's important for bond fund investors is where long-term interest rates go. So the rule of thumb is for the typical bond fund, a 1 percentage point increase in the long-term interest rate will reduce their overall return by about 4%.
So it could be a 4% cut, but we do not necessarily expect that just because short-term rates go up by 3 percentage points, that long-term rates will do the same, do we?
Typically, when the Fed begins to raise interest rates, short-term rates will move more than long-term interest rates. And the reason is that markets begin to anticipate a Fed move, and they begin to price that into longer-term interest rates.
So, but if rates went up 3 percentage points, you're saying that would be a 12% decline in my share price value?
Well, only if it occurred like on one day.
Yeah,
so
quickly.
If it's spread out for a long period of time, let's say over several years, remember, you're getting interest all the time on that bond fund, and that's catching you back up to where that price movement has been.
And there's a lot that the bond fund manager can do tactically in that environment to blunt the impact of those rising rates, right?
Absolutely. To some extent.
They're going to be rolling over bonds.
They're going to be rolling over bonds or be bringing new bonds in that are at the higher interest rate. This begins to catch up. So when a bond fund investor has a temporary loss, it is only temporary, unless there's a default, because interest rates eventually rise and that higher interest catches you back up to where you were before.
But you, very quickly, you do need to know what the duration is or the average maturity is of your bond portfolio. The longer, generally, the more you are at risk of rising rates, right?
That's right. The longer duration, the typical bond fund has about a 4 to 4.5 year duration. You should look to see what your bond fund's average maturity or duration is and see if you want to be longer or shorter.
Brian, thank you very much.
Thank
Brian
you.
Reed of the Investment Company Institute. All right, folks, that's Nightly Business Report for what a day, Sue, in Washington. Tyler Mathisen signing off from outside the Fed.
Come home soon, Ty. We'll see you tomorrow. I'm Sue Herrera. Have a great evening, everybody. We will see you right back here tomorrow night.